Hello everyone, in this video I'm going to be talking about 5.1 business finance needs and sources. So what do finance departments do? So basically they prepare final accounts, they record all financial transactions, they forecast cash flows, they produce account information for managers, and they make important financial decisions. Now, businesses need finance for three main reasons: when they are starting up a business, when they're expanding a business, and when they need additional working capital. When they are starting up a business, they need to obviously buy things like buildings, land, or equipment, and obviously they need to make sure they have enough inventory so that they have enough products to sell. They need startup capital, so this is finance needed for a new business. When you're expanding a business, you need to maybe buy additional fixed assets to be bought. You need to take over another business, or maybe they develop new products. And additional working capital. Now, working capital is finance that's needed for day-to-day costs. These can be used to pay wages, salaries, raw materials, buy raw materials, or maybe pay bills. For all these examples, businesses will need finance to pay either capital expenditure, that's money spent on non-current or fixed assets. Now, these last for more than 1 year. For example, purchasing a building, computers, or maybe gym equipment. Now, revenue expenditure is money that is spent on day-to-day expenses like water bills, employees' wages, or maintenance of certain pieces of equipment. Now, there are short-term and long-term goals. Short-term financial needs are ones that you need soon and regularly, and long-term financial needs are ones that you need over a long period of time. Next, we're going to look at the main sources of finance. Now, there are internal and external sources and short and long-term sources of finance. These do overlap, and we're going to go through them now. Internal sources of finance are from within the business, and external are obtained from sources outside of or separate to the business. Here are the lists of internal and external sources of finance. We're going to go through each of these now. Retained profit. Now, this is profit that has been retained by the business, has been earned by the business. It's spare money. So either it can go into the owner's pocket or you can retain it into the business. Some businesses, however, might not have retained profit, and it reduces the payment to the owners and the shareholders at the end of each year, but it does not have to be repaid and there's no interest. Sale of existing assets. Maybe you want to sell some some buildings or equipment. It's better use of capital and it doesn't increase your debts, but it may take time to sell the asset and it's not available for new businesses. You might want to sell your inventory. This reduces storage costs, but it must be done carefully so inventory levels don't get too low and your customers don't get disappointed. You might use your owner's savings. Obviously, this is available quickly and no interest is paid, but there might not be enough savings and it increases the risk for the owner. Now we're moving on to external sources of finance from outside of the business. Now you might want to issue shares. You want to sell some more shares. This is a permanent source of capital and there's no interest, but it's only possible for limited companies, and the dividends are paid after tax and they are expected by shareholders. You also might lose control of the company depending on how many shares you sell. Bank loans, obviously loans from a bank, usually quick to arrange, and large companies usually get low interest rates, but they have to be paid eventually, and security is required for the bank. So if the business cannot pay, then something of value to the business will have to be reclaimed by the bank. Selling debentures, these are long-term bank loans. It could be used for long-term finance, but obviously it still has to be paid off eventually. Factoring of debts. Now, just to explain a little bit about this first, a company sells its debts to an outside agency, the factor. Now, the agency will pay them in cash, but they aren't going to pay them the 100% that the debts are worth, maybe 90%. The agency can then reclaim all 100% of the debts itself. Now, good things for the business, it's immediate cash, and the risk and time of collecting the cash from its debtors is no longer a problem. But they don't receive 100% of the debt that they are owed. They're going to receive less. Grants and subsidies from outside agencies, including the government, these usually do not have to be repaid, but they are often conditional on the business doing something like locating in an undesirable area. Microfinance. So in low-income developing countries, commercial banks do not want to lend out to poor people as it's too much risk. So special institutions have been set up to meet the financial needs of poor people. These institutions focus on lending small sums of money to these people, and micro equals small. Crowdfunding can also be an online platform. Entrepreneurs often use this platform to crowdfund, to fund their business ideas. There are no initial fees, and it can test the public reaction, and it can be a fast way to raise money, but the platform, the crowdfunding, might reject the proposal, and if the total money amount is not raised, the finance might not be paid. You need media interest for the best chance, and people might steal your idea from the internet. Now I'm going to move on to short and long-term sources of finance. Now, short and long-term sources are listed here. Some of them overlap with the internal and external. So overdrafts. Now, this is money arranged by the bank. Basically, the bank gives the business the right to spend more money than the business has in its bank account. So they can go into the negative. It's always a pre-agreed amount. The interest is only paid on the amount overdrawn, and the amount can vary from month to month, but the interest rates can be variable, and the bank can ask for the overdraft to be paid at short notice. Trade credit. So this is when a business and the supplier make an agreement, and the business says they will pay them at a later date. It's almost an interest-free loan, but the supplier may refuse, and also the trust between the supplier and the business might be ruined. Factoring of debts, we also spoke about this before. Bank loans, we also spoke about this before. Hire purchase, this is when a business, long-term now. We're on long-term sources of finance. Hire purchase, this is a business to buy a non-current fixed asset with monthly payments. It means they don't have to pay a large sum of cash at once, but often there's a cash deposit at the start, and sometimes the interest payments are quite high, so it means you end up paying more. Leasing, so businesses maybe for equipment, they don't want to buy the equipment, so they lease it, means they kind of rent, but they don't have to buy it, so they don't have to find a large sum of cash. And the maintenance of the item is often carried out by the company that rented or leased the item to you. But the total cost of leasing might be higher than actually purchasing the asset in the first place. Issue of shares, we have spoken about before as well. This is another long-term source of finance. And selling debentures as well. All right, so how to choose a source of finance? So there are 5 things to think about. You need to think about the time period. Do you need it for a long time or a short time? How much money do you need? What is the kind of legal structure behind it? So bigger companies have a better choice with this because obviously they have more money and they have more power. Control, do you want to risk losing the control of your company? And risk and gearing, does the company already have loans? So the gearing is how much finance is raised on long-term loans. So if you have a lot of loans already, often it's not very good to keep piling on the loans as well. The last thing, you need to be able to recommend and justify appropriate sources of finance in given circumstances. So you need to make sure that you've had a look at some of the examples in the textbook and you're able to answer past paper questions about that. That's it for 5.1, and make sure you use your textbook, your revision book and your notes alongside this video.